Hello, this is Bill Scheid from Applied Finance Research with a look at the impact of the optional volatility stops and shorts that we teach as part of our monthly asset allocation systems. So here we have backtest data for one of our momentum-based monthly asset allocation systems, and these data were generated by etfreplay.com and further analyzed by Excel. This is a backtest that goes from December of 2007 to July of 2023. So we have three different columns here. For the column labeled SPY, we have stats for the buy and hold return of the S&P 500. The column labeled standard is the classic or out-of-the-box rule set for one configuration of the momentum systems that we teach. Not the only one, but one configuration. If you're familiar with Dr. Ken Long's BMR systems, this rule set would look very familiar to you. The column labeled vol stop plus short has the results for adding the optional volatility stops and short positions. And a note here that in these data, the maximum drawdown for the volatility stop and short numbers is calculated on a month-end basis, while SPY and standard are calculated on a daily basis. So it's not exactly apples to apples, but it is enough to give us a bit of an insight when it comes to this particular piece of data for maximum drawdown. Now, for the standard rule set, we have a total return of 693.1, more than double that of the S&P on only 60% of the S&P drawdown. The standard rule set has a compounded annual growth rate of 14.2% versus 9.7% for S&P, and a return to drawdown ratio of 20.2, which is more than 3 times better than the S&P. So out of the box, this system has some excellent results as compared to the S&P 500. Now, when we add the optional volatility stop and shorts, we see that the total return goes from 323 for SPY to 693.1 for standard, and then jumps to 960% when we add these options. Maximum drawdown gets cut more or less in half from the standard to minus 15.7, CAGR jumps to 16.4, and our return to drawdown ratio jumps to 61.1. So now we're at about 10 times the return to drawdown ratio of the S&P. So to summarize, while the standard system already had excellent returns, the addition of the volatility stops and the shorts has a big impact when it comes to increasing return and decreasing drawdown. So for those of you who already know and like Dr. Ken Long's BMR systems, you'll love this evolution of his work. Now, how do the volatility stops and shorts work? Well, without giving away too much of the secret sauce, for the volatility stops, we look at a measure of the daily downside volatility of the market as a whole. And when that volatility reaches or exceeds a certain level, we exit our equity positions. We know from our research that meeting or exceeding this level of downside volatility generally means that there's a market decline ahead, and sometimes a larger than usual market decline. And we know that these are not favorable conditions for being long equities. Now, you'll notice that I did say daily volatility. So if you're going to add this optional rule, you would want to look at the markets daily. It doesn't have to be during market hours. You can look at it after hours if you're otherwise tied up. And you don't need any special indicators for this measure of volatility. The value that we look at is available on any free market service out there, Yahoo Finance, Google, the standard stock app on your iPhone, etc. The short positions evolved out of the volatility stop. I said a second ago that we know from our research that meeting or exceeding this given level of daily downside volatility generally means that there's a market decline ahead. Specifically, what we found is that these downside volatility signals tend to cluster. So increased volatility tends to beget further increased volatility. Drops in the market tend to precipitate further drops in the market. And this phenomenon tends to happen more so in certain bear market conditions, which we've also quantified and defined in our research. So the logic is that when we see one of these volatility signals, And when we see these specific bear market conditions at the same time, we exit our equity positions, but instead of just moving to cash or money market or T-bills, we get short so we can profit from what tends to be those further market declines ahead. The shorts also do require daily monitoring instead of monthly monitoring, because shorts and bear markets in general tend to be more volatile than bull markets. So we don't want to give it too much room to go against us if the market's not going to drop like we anticipate. And to reiterate, the volatility stop and shorts are optional. So if you can't or don't want to monitor the markets on a daily basis, the standard rule set already has excellent performance, and you only need to look at it once a month. In fact, I traded all these systems for years before I created the volatility stops and shorts, and I got excellent results just monitoring monthly. And another thing I want to stress here is that the results we're looking at are for one configuration of one of the momentum systems. So one of the things that I really think is important about these systems is that these systems are highly customizable. You can configure a flavor of the system that's going to meet your particular objectives in terms of return and maximum drawdown. So what we're seeing here is just one example of one configuration, certainly not the only configuration, and certainly these are not the only results that are out there with these systems. So if you'd like more information on these systems, please visit us at appliedfinanceresearch.com or click on any of the links below this video. Thanks for watching, and happy investing.